Imagine waking up in your mid-40s, no alarm clock, no commute, no boss telling you what to do, because your investments are paying you enough to retire early, forever. And all you had to do was invest £500 a month in a simple index fund. Over the past 24 years, I've had to learn investing the hard way. I even wrote a book about it. That's why I'm passionate about helping people with my experience. Today, I'll show you exactly what index funds are, how to invest in them step by step, and how this simple plan can build you a huge retirement pot in just 27 years. After that, I'll show you how to avoid the biggest mistakes that stop most people from ever achieving this sort of early retirement. Section 1. What are index funds? First, let's make index funds nice and simple. Pretty much what this channel is all about. Most people think investing is about picking the next Apple or Tesla. But here's the truth. Even professional fund managers with PhDs and decades of experience working in finance fail to beat the market most years. So what chance do we have? That's where index funds come in. An index fund is a basket of hundreds or even thousands of companies designed to track the performance of a market index. For example, the S&P 500 tracks the 500 largest US companies. The FTSE Global All Cap Index Fund tracks over 7,000 companies worldwide. Imagine going to a horse race and betting on every horse. You won't make the most if a single horse wins by a mile, but you will win whenever the market wins, which over the long term, it almost always does. Long story short, you own a small piece of every major company. If the world economy grows, your money grows. Here's a powerful example of why investing into assets is so important. I invested £500 a month into a stocks and shares ISA at 18 for 6 months, but stopped and spent all my money on a lad's holiday to Ibiza. Huge mistake. This was down to a lack of financial education. Let's say I was taught about things like compound interest at school. I know for a fact I would have invested from 18 to now. So that's a full 24 years. If I got average returns of 10%, that would mean I'll be sat on £594,000. And looking at that huge amount, 450,000 of it is made up of interest earned. This is the power of consistent investing in index funds, the power of compound interest. The question is this: does this drive home the importance of how important it is to invest? Let me know below, are you an investor or a saver? Section 2. Why index funds beat most investors. So why not just pick individual stocks? Because studies show over 80% of actively managed funds fail to beat the index over a 15-year period. Picking individual stocks increases your risk massively. If you're wrong, you lose big, like I did in 2010 and 2011 when I lost our life savings gambling on individual stocks, gambling without any financial education. With index funds, your risk is spread across the entire market. You pay low fees like 0.07% versus 1 to 2% with managed funds. You don't need to watch the market daily, read reports, or guess. In short, you're not trying to beat the market, you're just owning the market, letting it work for you while you focus on your career, your family, and your life. Before we crack on, this video doesn't contain any financial advice. See below for the full disclaimer. Section 3. How to invest in index fund, step by step. Let's break down exactly what you need to do. Step 1. Open the right account. In the UK, you have two main options: stocks and shares ISAs, where you can invest up to £20,000 per year, completely tax-free on gains and dividends. SIP, self-invested personal pension. Invest pre-tax income, get tax relief, but money is locked until retirement age, currently 55 to 57. For maximum flexibility, start with the stocks and shares ISA. For maximizing tax relief, add a SIP later. Step 2, choose a low-cost platform. Examples: Vanguard, AJ Bell, Hargreaves and Lansdown, Fidelity. Look for low platform fees and access to global index funds. Step 3, choose your index fund. If you want global diversification, choose a global index fund like the Vanguard FTSE Global All Cap or Fidelity Index World. US exposure, choose an S&P 500 index fund. For most investors, a global all cap index fund is the simplest and most diversified choice. Step 4, set up monthly investing. This is the magic. Set up an automatic direct debit for £500 a month, for example. Choose to automatically reinvest dividends. This removes emotion and ensures you invest whether markets are up or down, which builds wealth consistently. Step 5, leave it alone. Don't check your account daily. Don't panic when markets drop. Stay invested for decades, not months. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. Section 4, how to retire in 27 years with £500 a month. Here's the exciting part. If you invest £500 a month with an average annual return of 10%, which is roughly what global stock markets have delivered historically, here's what happens. After 10 years, 95,000. After 20 years, 343,000. After 27 years, 583,000. This is based on compound interest. What does 583,000 mean for retirement? Using the 4% safe withdrawal rate, this gives you 23,000 annual income without running out of money. Is this enough? I'm not sure. Imagine retirement at 52 if you start at 25, or at 55 you start at 28, or retirement even earlier if you can invest more each month. Do you think you could retire with a pot of £583,000? 23,000 might not seem a lot if you go with a 4% rule, but what if you purchased 5 rental properties with that money and paid the mortgages off? Here in Middlesbrough, you could easily buy 5 rentals outright for 500k, leaving you with 83k left over, which is a lovely little cash buffer. And you would have £3,500 coming in each month from the rent, or £42,000 per year. That sounds more like it to me personally. But we're all different as investors, and we'll invest or should invest based on our risk tolerance and financial goals. Section 5, biggest mistakes to avoid. Here are 3 mistakes that destroy this plan for most people. Mistake 1, trying to time the market. No one knows when markets will rise or fall. Staying invested beats trying to guess. Mistake 2, paying high fees. An actively managed fund charges 1.1 to 2% versus an index fund which is much lower. This costs hundreds of thousands over a lifetime. Always check the fees before investing. This is pretty much the first thing I learned when I started really taking financial education seriously back in 2019. Mistake 3, selling in a crash. Markets crash every few years. Historically, they always recover. Selling locks in your losses and destroys your returns. Section 6, final push. Let me leave you with this. You don't need to earn 6 figures. You don't need to start a business. Not necessarily. You don't need to pick winning stocks. You just need to invest consistently in a low-cost index fund and give it time. 27 years from now, your future self will thank you for the financial freedom and peace of mind you built with these simple, boring, but powerful steps. 27 years might sound like a random amount of years. I'm just thinking about what would happen if I kept investing from 18 to 45. Summary. If you want my index investing cheat sheet, type yes below in the comments. If you take anything away from this video, remember this. Retirement is about having enough invested to cover your lifestyle forever. Let me know in the comments, at what age do you want to retire? How much would you need invested to feel free? So if you invest into an index fund within your stocks and shares ISA, you can retire in like 20 odd years or maybe 30 years. But what if you're not quite sure? Well, see below and you'll find a recent video with loads of info on how you can retire using a UK stocks and shares ISA. Now, I reply to every single comment, and your answers or comments help to inspire others on their journey to early retirement. If you want more steps, simple steps to help you retire, keep tuned in for my next few videos. Hit the like button, subscribe, all the good stuff, and thanks for watching.